The Mortgage Minute today being brought to you by our friends at Geneva Financial. When you're ready for that next home loan, Geneva's got the programs and the products. You just need to make the call, 800-306-1990, 800-306-1990. S&P 500 now down 2.10. 10-year Treasury down 9 basis points, 3.925. Mortgage-backed securities are up 59 basis points. We like that. Up 59. Means that interest rates are down. And speaking of interest rates, and you remember I just told you that Freddie Mac came out with their mortgage market survey. 7.08% this morning. You had to pay 8/10 to get it. But our friends over at OBMMI, they provide the most comprehensive, accurate, timely, and interactive analysis of pricing ever conducted in the mortgage industry, calculated from actual lock rates, with consumers across 35% of all mortgage transactions nationwide. The 30-year conforming loans locked yesterday at 7.009. The jumbos, 6.908. FHA, 6.793. USDA loans, no down payment most of the time, 6.801. And the best loan on the market for those who qualify, the 30-year VA loan, 6.718. That's what they locked at yesterday, again, across 35% of the market. But let's take a look. What we really want to know is, why is this happening? Well, we did get our first reading. Yeah, the advanced reading of the first read of Q3 GDP showed that the U.S. economy grew at an annualized rate of 2.6%. That was better than the 2.3 expected, and follows 2 consecutive quarters in the first and second quarter of negative GDP. Important to remember that this is just the first of 3 readings, and there can be significant revisions. Core durable goods for September was also released and showed a decline of 0.7% month over month, which was much weaker than the 0.3% gain expected. Additionally, the August report was revised lower by 0.6%. Shipments also came in light. Both of these components get factored into GDP and may lead to some downward revisions in the upcoming releases of the Q3 GDP. Initial jobless claims measures individuals filing unemployment benefits for the very first time, increased by 3,000 to 217,000. Continuing claims are those that continue to receive benefits after their initial claim, rose 55,000 to 1.438 million, and has been significantly rising over the past few weeks. Bottom line, initial claims still remain quite low as employers continue to hold on to workers. The rate of hiring is the first to slow in an economic downturn, followed by layoffs. Next week's payroll forecast is 190,000, which would be the slowest since a negative print was seen in December of 2020. CoreLogic released their loan performance insights for August, showing that loans 30 days or more past due decreased from 3% to 2.8%. That's almost a 10% drop. Loans seriously delinquent or 90 days plus decreased from 1.3 to 1.2, while loans in foreclosure remained at 0.3%, which is near multi-decade lows. Overall, delinquencies improved from the previous report and remained at very healthy levels, even in this high inflation, high interest rate environment. Tomorrow, we're going to get the core PCE inflation report, which is the Fed's favorite measure of inflation. Estimates are for core inflation to rise from 4.9 to 5.2 year over year, which would be a negative for the bond market. However, we already knew that inflation went the wrong way in September after the release of the core consumer price index report 2 weeks ago. And since the market already reacted to that release, I don't think there's going to be too much in the way of surprises in the market tomorrow. Last month, a similar picture unfolded and the market handled it pretty well. So that is the Mortgage Minute today, being brought to you by our friends at Geneva Financial. When you're ready for that next home loan, Geneva's got the programs and the products. You just need to make the call, 800-306-1990, 800-306-1990.